Ladies and gentlemen, good day and welcome to Galaxy Surfactants Limited Q1 FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nitin Shekhar, Promoter and Managing Director of Galaxy Surfactants Limited. Thank you and over to you, sir.
Thank you. A very good afternoon, ladies and gentlemen. Welcome to this first quarterly earnings call for FY23. And let me wish all of you and your family members a safe and healthy living. In financial year 2016, Galaxy's full year profit stood at 101 crores. It gives me immense pleasure to share with you that despite numerous challenges we have witnessed in the last 6 years, Galaxy's march has consistently continued. As we see the world gradually moving back to normalcy, the year FY23 began on a very positive note for your company as well. For the first time in the history of Galaxy, we have crossed the 100 crore profit mark. Despite facing a setback in Q2 and Q3 of last year, we not only rebounded in Q4, but we were also able to sustain the momentum in Q1 of FY23. Improving supply chain conditions, better mix realizations, new age products and leveraging on emerging opportunities have helped us achieve this growth. As you would have noticed, our EBITDA per metric ton for the quarter stood at 26,418. While we had a good start, the strong persistent inflationary headwinds impacting both the developed and developing economies, though with varying intensity, remains a cause of concern for us. As stated previously, FY23 will be all about managing supply as well as demand side risks. While supply side factors did improve in this quarter, they are yet to revert to pre-pandemic levels. This inflationary scenario, globally combined with the deterioration of macro factors of a few countries, severely has impacted the mass categories, which in turn impacted our performance surfactants volumes. And this impact was particularly adverse in AMET. The AMET region declined by almost 21% year on year. The energy crisis in Europe and the impending slowdown remains a cause of worry and risk for our specialty care products going ahead. This is reflected in our ROW performance, which declined 5.5% year on year. However, on the brighter side, demand in India continued to remain stable and showed signs of improvement, the quarter on quarter by growing 8.5%. With the upcoming festive seasons, we believe the demand will pick up momentum from Q2 onwards. Recently, keeping in mind the needs of the future, Galaxy launched shampoo bar-based Galaxy Trescon. These are solid bars for shampoos prepared with a solid surfactant system that finds best fit value as it enables multiple sustainability elements such as reducing the usage of fuel, space, utilities, and water. The ingredients used are also sustainable and are derived from our patented amino acid-based green chemistry. This is in line with our overall sustainability initiatives. The earlier planned capacities have got commissioned in this quarter and will help us grow in terms of value. While Q1 FY23 has been a good start, going ahead, a conducive environment will be helpful to ensure that the momentum continues. At Galaxy, we remain committed to enabling and ensuring the same. Thank you, ladies and gentlemen.
Sir, should we open up for questions?
Yes, please.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may kindly press star 1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to restrict your questions to 2 per participant. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sanjesh Jain from ICICI Securities. Kindly proceed.
Good afternoon, sir.
Good afternoon.
Thanks for taking my call. Thanks for taking this question. And few from my side. This quarter looks like a performance in 2 halves. India still struggling, as in standalone still struggling. Margins are dipping. While the Concall minus standalone, which I think predominantly is our US and Egypt, there the margins continues to increase significantly. Now we are there at 23% EBITDA margin, 48% gross profit margin. 2 part in it. How is the US doing? Number 2, is that specialty which we are manufacturing now and supplying to US, a significant portion of margin is captured in the US subsidiary? And this is despite the weakness in Egypt, right? So Egypt, I think it still continue to struggle. So what is driving such a strong performance in the non-standalone entity? And what is the steady state margin should we look at there? That's my first question.
Sanjesh, yes, the US has done well and has been pretty consistent in the last maybe 18 to 24 months. And touchwood, we would expect it to continue, but we have to be candid enough to say that one does see stress on consumption even in the US market. That said, the US operations also sells products of Galaxy because, as you know, it's important that we maintain the stocks of these products at the warehouses in USA so that we are enabled to serve our customers from our warehouses there. So, a number of specialty products which goes from India gets serviced through the US subsidiary. So, Egypt has certainly, declined. But when you talk about India, Indian volumes have grown certainly in the last quarter. We have grown ahead of the market. We have taken shares, but there are still a lot of what I would call operational bottlenecks which emerge because the supply chain situation has not come back to real normalcy. There are even today there are certainly significant amount of disruptions and disturbances continuing. And these have to level in terms of having what I would call a rhythmic performance as far as India is concerned in terms of operations. Yeah.
No, what is driving such a strong growth in US? Can help us understand protein, because I don't think we have expanded that much.
So as far as US is concerned, as we said, the introduction of these new products certainly has driven growth. One, of course. Also, the innovation on proteins that we do has been driving our growth as far as the protein segment is concerned in US. Plus, this introduction of specialty products made at the Galaxy India. These are also sold very well in US.
No, that I got the point. I'm telling you, what is this incrementally driving this strong growth? Is a combination of all these products. It is mild surfactant portfolio, it is preservative portfolio, it's protein portfolio, and How much of
But you have seen, Sanjesh, you would have seen that our concern will be the volume degrowth that we have seen at the overall level. So we have the strong performance has been because of the mix and the introduction of new products.
Okay. And as the Egypt picks up, the mix will move towards performance and margins.
Yes,
That is a fair understanding.
Yes.
Okay. Continuing with the margin, now we are at 26 rupees to a kg kind of a EBITDA. Our guidance is 16 to 18. It looks like we have come a long way from 16 to 18. Do we still want to stick with 16 to 18, or do you think sustainably we have moved to a...
Sanjesh, we have a particular mix of performance surfactants and specialty products in mind. Okay. Now there may be temporary deviations with respect to this, and particularly in the last 1 year or 18 months, the deviations have been one too many. There have been a whole lot of disruptions as well as volatilities. Whether you talk about the geopolitical unrests or the various different markets behaving in different ways at different points of time. So we need to see some element of what I would call a rhythm or a steady state, which has not been there for the last almost 18 to 24 months.
One other reason, Sanjesh, that we also need to factor in is, given this severe inflationary scenario leading to recession, if you look at our specialty portfolio, we have a good portfolio in terms of a new age products, good pipeline of projects in place, good amount of combustion will happen. But given this scenario, we cannot rule out, maybe some of the customers reformulating because they need to manage their cost structures, which will be temporary, but we need to be cautious of that as well. So that's one of the reasons why we don't want to be changing the band beyond the 16 to 18,000. But we're sure that we will be at the higher end of this band of 16 to 18,000.
Natarajan sir, just to put in, to understand it.
Excuse me, Mr. Jain, I'm sorry to interrupt, sir.
The follow-up and the last. Just to understand that, is this EBITDA of 150 crore, what we have done in this quarter, right? Forget about the EBITDA per kg and all. Is this 150 is sustainable and can grow from here? Now, considering this is on a lower volume, our volumes will come back. Do you think this 150 crore is a sustainable and this becomes a new base and we will grow it from here?
We would aspire it to be there, yes. I think all of us would like it to be there. Okay. But as we said, there are a whole lot of challenges which are possible. We don't want to be blind to that. Okay. So we would certainly be careful and alert both to the opportunities as well as to the challenges that can emerge. Yeah.
Okay, fair, sir. I will come back in the queue for more questions. Thank you and best of luck for the coming quarter.
Thank you. Participants, if you wish to ask a question, kindly press *1. The next question is from the line of Rohan Gupta from Edelweiss. Kindly proceed.
So, hi sir, good morning and congratulations on such a strong set of numbers, despite we have seen that the pressure on volumes. Sir, I just extending from the previous conversation that definitely the performance from non-surfactant or specialty business has been very solid, and especially coming from the developed market. You gave that the reason for that is basically the new product launches, which has led to strong profitability and higher margins. Once we come back to the previous level in terms of product mix with the higher revenue coming from the surfactants, then you are cautioning us that that may go back to the previous level of or your earlier guidance of 16 to 18,000 rupees per ton. Sir, the products which we have launched are definitely new age and are clear indication that we have the ability and capability of launching new age products with a very high margins which are much higher than the current business. Then only we are probably able to enjoy 25 to 26,000 rupees EBITDA per ton, what we are enjoying right now. So the question which I have is that are there any doubt or issues you think that in our ability to keep on launching new such products in next 1 year to 2 years, that we keep on improving our product mix? I'm not saying that we want to get away from our basic surfactant business model, but I'm saying that the performance which has been driven in last 1.5 years, and when we have commissioned our specialty chemical business in last year with the additional capacities, why we think or assume that the specialty part of the products or high value added products will not keep on driving the revenue growth even in next 1 to 2 years also?
See, Rohan, thank you. See, we have seen the end-use market, and particularly this year, because of the real hyperinflation, the stress on consumption we have started experiencing across various markets. Customers, when there is an hyperinflation, like it happened about 3 years back, 4 years back, tend to downtrade. Okay, and when that happens, the store brands start gaining traction for that particular period of time. Of course, the consumers come back to the mass and the masstige. When you talk about specialty, as you know, the specialty products find use or find their place in masstige and prestige brands. Okay, and they have to consistently grow, but which can be challenged during times of hyperinflation. So we know that we have talked about various trends on sustainability, going to prestige, but these premises get challenged during what is called difficult times for a consumer, and the difficult times can be when there is hyperinflation, which is what has happened now. Okay, now once the things start regularizing, and as you have seen, the commodity prices have started sharply coming down. Okay, now when that happens, I think the customer has certain flexibility in his wallet to indulge in prestige products also. Okay, so we would apprehend a temporary challenge possibly to this specialty growth. However, what I want to say is that we have had a continuous stream of innovations over the last 10 years or so. Galaxy has built its specialty portfolio significantly over the last year, and will continue to build. New products will keep coming out. But at the same time, we have to ensure that we do not ignore the broad market in all the emerging economies as well as the evolving economies, particularly the AMET region and the African region. Because Galaxy would like to be present across various consumer segments as a part of its strategy, both in emerging markets as well as developed markets. Yeah.
Okay, got it. So, sir, I think we are expecting hyperinflation, and we are fearing that. However, the raw material prices have already started coming down, as you rightly mentioned, and is already down by almost 30%.
Right.
I think that definitely we are not expecting the prices to go back to the previous level. But yes, I think that even they are also not likely to remain on the peak what we have seen in probably months of Feb or March.
Yeah.
So now, with the softening of the RM prices, and assuming that what are the current prices, and assuming that 10 to 20% further fall, and then RM prices stabilizing there, what you see and think that our percentage or EBITDA % margin can sustain? I hear you that you were consciously maintaining a 16 to 18,000 rupees at the upper end guidance.
Yeah.
But do you see that if the RM prices sustains here, maybe 10% lower from here, can we expect our EBITDA percentage margin, what we are enjoying right now, in terms of percentage, can sustain like 13%?
So, Rohan, let us wait for a few more quarters before we come to a secular trend. Let us wait for a few more quarters.
Okay. Sir, just next question, and I'll come back in queue for the follow-up. Sir, we have seen that our specialty products capacities launched last year. And if you can give us some sense in kind of utilization level there and at what are our utilization levels right now and the CapEx plan for the current year, and I think that our CapEx will be much lower than the free cash flow which we will be generating. So what are the plans for our additional free cash flow which we have? That's it.
Yeah, Rohan, so now, Natarajan here. So capacity utilization has been about 64%. And the capacity we added were all onto the specialty ingredients segment, and which obviously has been, we have started utilizing those capacities in line with the way the projects of the customers are maturing. With regard to our deployment of the cash, we've said, typical capex outlay would be about 150 crores per annum, and we do have projects that have been rolled out on both the performance and specialty ingredients segment over the next 2 years. So per annum, we'll be having about 150 crores of capital outlay on our expansions.
Okay. Thank you, sir. Thank you.
Thank you. Participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Rohit Nagraj from Centrum Broking. Kindly proceed.
Yeah, thanks for the opportunity and congrats on a very strong set of numbers. So first question, again, harping on the EBITDA per ton metric. So is it because that there has been a lag in terms of the input cost inflation which has been passed on, and prior to 2 quarters back, we had struggled to keep the EBITDA per ton at our prescribed level? And because of which this impact has come in Q4 as well as Q1, and incrementally as the raw material prices subside, based on your commentary, it will normalize to our 16 to 18,000 tons per level. Is that the right understanding?
Yeah, that's the right understanding. Only thing is what we need to, when in Q2 and Q3 of last year, when the performance got significantly impacted, we said the raw material prices have been increasing pretty, both the frequency and the intensity of the increase was pretty high. And then by the time you're passing on one increase, the price will go up further. And from Q4 it stabilized, although at higher levels. And that continues. So you're right in that understanding, because it enables us to then not have an impact, because we've not been able to pass on, because you pass on, say, with a lag of a quarter.
Right, got it. So the second question is, in the last couple of quarters, despite the lower volume, where we benefited because of the supply chain challenges probably faced by our competitors, and we had to supply with hand across different geographies, because of which we had been able to charge slight premium instead of the normal pricing. Thank you.
So can you repeat your question, Rohit? I couldn't get it clearly.
Right. So in Q4 and Q1, because of maybe supply chain challenges faced by competitors, where we benefited in terms of pricing premium for our products because our products are available at different geographies.
No, so like I said, there were opportunities that got presented, the challenges, but I think the story of the last quarter has been where we managed the challenges well and leveraged on the opportunities that got presented. So.
Right.
And also what is important is that given this particular uncertainty in terms of various economies being in trouble, so we have also been choosy in terms of which customers we'll be selling to, because there is also a risk that we need to be very wary about. Just in case the economies are not doing well, the customers base there. So how do we then recalibrate our customer portfolio? That's also been one way that we have been able to rejig our customer portfolio to aid our numbers.
Right, so got it. So just one last clarification.
Sorry to interrupt, sir.
I'll come back in a bit.
Yeah, thank you. Participants, if you wish to ask a question, please press star 1. The next question is from the line of Anupam Tiwari from Axis Mutual Fund. Kindly proceed.
Yeah, good morning, sir. Anupam here.
Yes, sir, we can hear you.
Hello, can you hear me?
Yes, Mr. Tiwari, we can hear you.
Okay. Good morning, sir.
Good morning.
Sir, wanted to understand a little in detail, if possible, in terms of green surfactants. So I'm sure you guys also have green surfactants in your portfolio, but the way things are being defined now, so whether, let's say, a sulfate-free surfactant can be classified as a pure green surfactant or it's a partial green surfactant, and is there any newer kind of product with a very different technologies are being accepted in market as green surfactant, and where our product development stands in terms of this journey to reach to pure green surfactants? If you can help us understand.
Yeah, thank you, Anupam. I think Galaxy has been a significant player and leader as far as green surfactants are concerned. As you know, our amino acid surfactants, which has a world patent, an exclusive patent, is totally based on green chemistry, which gives us a very exclusive edge. One. Again, our non-toxic preservatives are from green sources. We introduced a product called sodium lauryl lactylate, which is totally green surfactant cum emulsifier in this particular year. So, and as a matter of fact, a significant amount of growth that we have seen in the last 3 years with respect to specialty products have come from our green chemistry, green innovations, and this is an important priority as far as the organization is concerned. And so sustainability is built in our developments. So a whole lot of our specialty products are based on green chemistry, where the effort is with respect to atom efficiency, recycling, very negligible or minimal environmental footprint, no wastage. So these are the various elements of green chemistry. As a matter of fact, our patent that we had fulfilled all the 12 principles of green chemistry. So, and this has been very well acknowledged not only by industry bodies, our competitors, our customers. As you know, we received the PC Ray Award instituted by the Indian Chemical Council last year for our innovation with respect to the amino acid surfactants.
Mm-hmm. And sir, how is the competitive situation over here globally in terms of offering pure green products?
See, Anupam, as far as the personal home care industry is concerned, there are a whole lot of products. There are huge number of customers and huge number of players also. So when you talk about edge, yes, one does have an edge when you play in the same these things. But different players have different edges in different niches. Okay, that is a reality as far as the personal care market is concerned, because there is a place for a large number of people.
Very good.
Yeah.
And in terms of customer acceptance, what I'm talking about is the end customer acceptance, not your client.
Yeah.
For green products.
Yeah.
I'm sure they would be expensive. So, in terms of cost acceptance, how it is panning out globally?
No. So here it is one of, let us say, what you are creating and responding to the various emerging consumer needs. And the the consumer needs are certainly distinctly towards sustainability and green, non-toxic, and less amount of what I would call so-called ingredients. People want as least the number of ingredients as possible. So that is where consumers, and this consumerism is primarily at a very high, significant level in the US and the Europe markets, and India is again catching up. So we do see a consistent growth of specialty products even in India, though albeit it is not as comparable as what is in US.
Mm-hmm.
But this is a significant and a definitive trend which is happening.
Mm-hmm. And sir, in terms of regulatory requirements on the surfactant side, are you seeing any change in next couple of years?
Yes. Particularly in US, there's a very major change happening on products, both home care products are expected to have dioxin less than 1 ppm. Okay, this is a New York directive which has come, which will go live by the end of this year. That is starting 1st January 2023. This is a very, very major change, and the Galaxy is already ready. As a matter of fact, one of the major innovations for this year in introduction is a product called Gal EcoSafe, which is the sodium lauryl ether sulfate, where we have been not only present but a significant player globally. And that will have a dioxin content of less than 5 ppm and 10 ppm, which ensures or enables the final consumer product to have dioxin less than 1 ppm. So these are regulatory challenges which have come as opportunities. We have responded to them. We are ready with the product, and we have already made foray into certain markets such in both Europe as well as US.
And just to
Mr. Tiwari, I'm sorry to interrupt, sir. We request you to kindly get back in the queue for further questions.
Okay.
Thank you. Participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Bobby J. from Falcon Investment. Kindly proceed.
Yeah, hello. The question is EBITDA per ton, 40% above the lower end of your range.
We can't hear you. I'm sorry. Can you please repeat it?
Yeah, talking about the EBITDA per ton, where for the past 2 quarters you have been around 40% higher than your normal range of 16 to 18K.
Yeah.
So if you're actually saying that you'll revert to the 16 to 18K, and your volumes don't grow up drastically, that would have a big impact on your profits.
See, as we said, there are a couple of parameters which were at play in the last 2 years. One was, of course, the supply chain geopolitical disturbances and the supply chain disturbances which impacted your rhythm of operations. Okay, both the predictability of operations, the planning of operations, the rhythm of operations, and the output of operations. Apart from that, the challenges with respect to outgoing cargo also put a spoke in terms of your dispatches and deliveries. So there was a huge supply chain elongation which the world experienced, including us. The second is, of course, because of these geopolitical uncertainties, there was hyperinflation which impacted consumption. And the impact or the stress on consumption, we are seeing it in a more pronounced way in the last quarter and possibly in the existing quarter. That is the quarter 2 of the financial year. That is July to maybe September, which we expect, we would see a stress on consumption in this quarter. The third is a number of economies, particularly have been gone into weakening, as a result of which we have been very, very choosy about customers because we want to protect ourselves against default. So that has also been where we have withdrawn ourselves with respect to certain economies and certain markets as a very conscious decision, which we will get back to once things come back to normalcy. So it is important that the world come back to normalcy, howsoever hopeless or hopeful it may seem. We would like the world to come back to normalcy so that there is predictability. Till that time, there will be an element of opportunism which is inherent, and there will also be these deviations that we have seen. But in a secular assumption, because the entire EBITDA guidance that we have given is based on a particular secular assumption. So for the next maybe let us say 3 or 4 quarters is concerned, and that's why we said that let us wait for a couple of quarters. But for the next 3 or 4 quarters is concerned, we would like to say that we would be at possibly the higher end of the EBITDA guidance that we have given.
Mr. Shekhar, I perfectly understand all that you have described, and we're well aware of it. I guess my specific question is, are you saying that when your EBITDA per ton reverts to the original state, your volumes would go up drastically?
Yeah, obviously.
Obviously. Yeah, that is what I'm trying to understand, because what we are concerned about as investors is your absolute profits. Right? If EBITDA per ton goes down and the volumes don't go up, your absolute profits will come down. It's just mathematical here. Right? So if I understand you correctly, what you're saying is as the consumption picks up, your volumes will climb up, and because there'll be more performance surfactants, your EBITDA per ton might edge lower. But the total would be, but the absolute numbers trend should continue. Is my understanding correct?
Yeah, right. Your understanding is right.
Okay, thank you. So that the other question was there was a drastic fall in fatty alcohol prices this quarter. So did you have? But your presentation doesn't mention any inventory losses or MTM losses or any such thing. So how did you manage that?
We have explained this. We have a very good risk management mechanism to ensure that the impacts are minimal. I mean, it's not that we will be totally immune to any impact, but the impacts are pretty minimal, and so that has been the case. So we have not had any significant impact because of this.
Would you have to pass the lower prices on to your
Mr. Jay, I'm sorry to interrupt, sir.
It's just part of the question. Just let me complete, please. Just part of the same question.
Sure.
Would the lower prices be passed on to your customers?
Obviously, yes. The competitive market or the competitive scenario ensures that ultimately the benefit of lower prices on feedstock will go to ultimately the consumers.
Okay. All right. Thank you. That's all.
Thank you. The next question is from the line of Krishan Parwani from JM Financial. Kindly proceed.
Yeah, hi sir. Congrats on a good set of numbers. So just two questions from my side. So the first is, just wanted to check, has there been any addition of value-added product in your performance products portfolio over the last couple of quarters?
We did mention, as far as performance products is concerned, the innovation that we worked on Gal EcoSafe, the SLE is having very, very low dioxin, which would help our customers to meet the New York regulations with respect to dioxin. So both, we have already launched this in Europe as well as USA. And we have already done significant amount of business or some businesses on this thing with our customers in Europe and US. Yeah.
So just on a follow-up on that, so what would be the contribution of these in the current performance surfactants volume? Like maybe a ballpark number should do, not an exact number.
Hey, not a very, very big number. It will gradually climb because the regulation will kick in only from 1st of January. Okay, whatever we have done or whatever customers have brought in is in the in the form of a preparation for themselves. Okay, the regulation starts kicking in only from 1st of January 2023.
Understood. So, and the second question is that, so basically, whatever price jump that we are witnessing in the performance surfactants is mainly driven by the higher input cost. Is that correct? Because you mentioned that value-added products addition is only limited.
Yeah. You're right. See, in performance surfactants, there's a very clear correlation in the market at the market level between your feedstock prices as well as the final selling prices.
Understood. That is very helpful, sir. And wish you all the best. Thank you so much.
Thank you.
Thank you. The next question is from the line of Pujan Shah from Congruence Advisors. Kindly proceed.
Hello, sir. Actually, I just wanted to have a broad outlook on performance in specialty. So we have a revenue segregation on performance and specialty, and on a moving trajectory like 4 to 5 years, are we be on the same line, or will specialty will contribute to let's say 50-50 or so? So can you just give some trajectory towards that?
Yes. See, we have always said that the split between performance and specialty will be 65-35. But this ratio will certainly go towards maybe to 60-40 or even maybe 55-45, but not overnight or immediate, but over a horizon of, let us say, 5 to 10 years or so.
Okay. And so my broad understanding would be, so majority of our our sales, you can say, would be on performance, but the margins would be contributing from the specialty. So more of the margins performance improvement will be from the specialty, and the sales performance could be majority from the performance, right? That is my understanding, correct?
Yes.
Okay. And my second question would be, can you just give us some, I was seeing the presentation, and in that, can you just give us the top 10 contribution products, how much contribution to the revenue it give us to? If top 10.
We wouldn't be able to talk on that.
Okay. That's from my side. Thank you, sir.
Thank you. The next question is from the line of Sanjay Jain from ICICI Securities. Kindly proceed.
Yeah, thanks for taking my question again, sir.
Yeah.
Few more on the volume side more. Wanted to understand how are we trending on month-on-month basis for the MAT. I know for the quarter we have declined by 29%. Last quarter it was 29. Just wanted to understand the progression. Is it on the improving side? Are we seeing the pressure coming down? That's one. Number two, on the rest of the world side, where we had declined 5.5% in the volume terms, like last quarter it was positive. And now that, given that we have commissioned the plant, that should give us a momentum in the new product as well. How should one think about the volume progression from here? And this is on the premise that India will continue to do good. Because now we are approaching festive season, the pressure on raw material side is coming down, so that will give some more push on the volume. Just wanted to understand how are we thinking of volume progression from here to say for next 4-5 quarters.
Yeah, so Sanjay, as far as the AMET volumes are concerned, I think it would have to be, we'll have to wait for the Egypt and Turkey market to really start coming back once they adjust to the significant inflation that they are having. So that's going to be very critical. And to your question whether we are seeing some green shoots and we see improving trend, I would say that directionally improving, but we will not be able to make any comment whether they will sustain, because we've also had Eid, which was there in the month of July. So we will not be able to make, so probably we'll be able to make a clear statement on the direction by end of this quarter. That's one. Second, with regard to the rest of the world, it is driven majorly by specialty ingredients. And only thing that we would want in terms of a conducive environment is that we have the inflationary situation correcting, the recession not prolonging, and that would enable us to be able to continue and leverage on the various projects that are matured on specialty ingredients with many of our customers.
No, just to continue there on the volume front, are we seeing any destocking because in the falling prices, and this commentary has come from multiple chemical companies, the customers tend to destock because they fear that they will continue to cost, and then so they keep destocking and they buy only just in time kind of a requirement.
Yeah,
is it also adding to the volume thing?
So that's also one of the reasons. But then if you look at, say, US, there is good amount of destocking that is happening, which is what many of our big customers who have been talking about, this being one of the reasons why their volumes have been lower. Because one is the pantry, stocking that was done by the households also has come down, which is then passed on into the chain, wherein you have all the big stores like the Walmart and all of them also destocking. That is one of the reasons why it's happening. Second is with the reducing prices, yes, they would want to be on the lower side of the inventory in the pipeline so that the impact in terms of a significant correction is limited in terms of the financial impact. So there's multiple reasons, but one major reason why all this is happening is the consumer demand itself is correcting from the highs that we have seen earlier because of the inflationary scenario. So we would only thing that can correct all this is the consumer demand, because destocking and all that is only a response by our customers, okay, to take care of the situation. But the moot point is how do we ensure, how does the consumer demand come back, okay, to the robust levels that it was, say, last year.
No, if I hear you properly, we are giving a very cautious statement on the volume growth, particularly Europe, US, where we are seeing stress. Are we seeing demand really slowing down, or it's just a transitory phase, or people are really facing the pinch? And now, because I think from the peak of the inflation, now we are only coming down in a road where the inflation will be lower than what it was earlier. So probably worst is behind on the inflation, and our performance even during the inflation was a very incredible performance. Why are we turning so cautious? Where we can, and or it is probably more imminent that the inflation will only.
So one of the reason is if you see the demand cutback that is happening, it started only beginning of last quarter, and the commodity price also started corrected only towards middle of the last quarter. So for things to settle down, come back and regain their robustness, okay, is something that we need to wait and watch. The other stuff also is in terms of in Europe, the energy crisis is going to have its own implications. So we need to wait and watch. So it's a combination of factors. Although we would want things to pan out the way that you have been articulating, that's what is going to be good for us, and that's what is a conducive environment that we would want it to be there for us to be able to churn out good volume numbers. But yes, we are not able to make any clear statement because of the headwinds that we're already seeing in the markets by the kind of commentary that our customers are giving.
I think Europe being in trouble probably is good news for us, because they will try to move outsource, and the production cost of the local surfactant guy, which any which way is sold at a very thin margin, for them to compete will be very different, very difficult, right? So for AMET market, we become even more efficient to look at in the Europe. Doesn't it make us even more efficient to export from AMET to Europe, and that market opens up very well for us?
Yeah, so that's what I said was, as we do see, because of the various geopolitical situation and the energy crisis, we have challenges that we need to be very properly managing, and it also presents us with opportunities that we as a team are well geared to leverage on. So you're right, if this particular hypothesis that you have is something that's really good, and if it pans out that way, we certainly would be well positioned to be leveraging on that opportunity. You're right.
My question is,
Mr. Jain, I'm sorry to interrupt, sir, but we'll have to just proceed to the next question.
Thank you, sir. Thank you very much.
Yeah.
The next question is from the line of Rohit Nagraj from Centrum Broking. Kindly proceed.
Yeah, sir, thanks for the opportunity. One question on how historically the FMCG company pricing has behaved during such events of hyperinflation. I mean, generally, once the FMCG consumer product is priced at a particular level, usually those prices do not correct. So historically, what is our understanding of the same in the last maybe 20-25 years? Thank you.
Yeah, so what we have seen is that it's all a question of how the consumers respond. So overall, if it doesn't reach the consumers too much in terms of their disposable income, then yes, they would not mind continuing to pay those high prices. But if you ask my personal opinion in terms of what would be the response to the current situation, I think everyone wants to be incentivizing consumer demand, and they would certainly end up passing on any reductions. But yes, they would want that to get a signal that it is going to sustain. So they don't want to be reducing it and increasing it again. So they would probably wait for some months, but surely everyone would want to pass on because they would want the demand to come back to the robust levels that they've seen earlier.
Right. So second, the bookkeeping question. We have seen that by end of FY22, the debt had increased. And given that we have very strong cash flows during Q1, how has been the debt situation at the end of the quarter? I mean, is it reduced substantially and probably reduce eventually over the next 3 quarters if kind of results coming?
Yeah, Abhijit, our CFO, will respond.
Yeah, hi. So the overall debt situation continues to be at the same levels that we had in the previous quarter, with debt equity ratios of around 0.2, and this will going ahead. There won't be any significant change going ahead till the end of the year in this.
Sure. Thank you so much. And that's it.
Thank you. The next question is from the line of Priyan Purohit from Kamaya Kia Wealth Management. Kindly proceed.
Yeah, hi. Thank you so much for the question. So, sir, I'm just trying to understand. So, there being 2 reasons here. First is that obviously there have been constraints on the volume side, as we were talking about, inflationary scenarios in your target markets. And secondly, with your RM prices coming down, as you'd already mentioned, that even the lower prices you will have to be passing them on to the consumers. So I'm just trying to understand, sir, like in both ways, these situations are not really working in our favor. So what exactly are the growth drivers for, say, the coming 2-3 quarters, or is the scenario just going to be like this and probably, we just have to wait and see what is going to happen? Or do you have some kind of a strategy now?
See, let us admit and acknowledge that the consumer demand is a very, very extremely important parameter. If the consumer doesn't buy, I don't think any unique strategy will make your sales grow. Okay. So it is important that the consumer demand comes back to robust levels. Now, all the indications are right for that to happen because the commodity prices are correcting. Okay. So, and you will also see some of the festival seasons coming back. People today, obviously, when we are coming back to normalcy with respect to daily life, I mean, maybe for the first time, India will be celebrating the festivals in full measure in this year, whether it is your Ganesh Chaturthi or Diwali. Okay. So these should certainly augur well as far as consumption is concerned. So our strategy is to ensure that we have a rhythmic operations. We are able to respond to our customer needs very well, which was a concern in the last 18 to 24 months because of supply chain disruptions. I'm not talking about just Indian customers, but I'm talking about our global customers, India as well as global. So we would want to ensure that we are able to very in an agile and a prompt way and a consistent way able to respond to various our consumer needs with respect to demands. The consumer demand to come back, and thirdly, the inflation to correct, because that will ensure that the value of a consumer is able to appropriately sort of devote some of it to the prestige products, which is what has driven the specialty portfolio and which will drive the specialty portfolio consistently. See, when there is a stress with respect to his value, the customer, or the consumer reverts back to minimalism, absolute minimal, whatever he wants to consume. That is what we have seen. We have also seen, for example, the reflection of this is consumers going back to store brands as well as dollar store brands in USA. Okay, and the same thing happens even in India. So these are the sort of situations that we would hope correct themselves in the coming quarters.
All right, understood. And sir, lastly, just one final question. You had mentioned earlier that you're looking to do capex of about 150 CR per annum for coming 1 or 2 years. So could you just elaborate a little bit more on that? Whether are you going for more capacity enhancements or is this just regular maintenance CapEx?
We maintain that. That will continue. We would have a capex of approximately 150 crores year on year.
No. Sir, my question was whether this is going for capacity enhancements or is this general maintenance capex only?
No, it will also be capacity enhancements. Some are already underway.
Okay.
Some are already underway. Yeah.
Okay, understood. Thanks a lot, sir.
Thank you. The next question is from the line of Rohan Gupta from Edelweiss. Kindly proceed.
Yeah, hi sir. Thank you for the follow-up. Sir, first question is on our working capital itself. So last year, because of the sharp increase in input prices, we have seen a large part of our cash flows was deployed in working capital, and that led to almost flattening of the debt level. And even also it was added up with the capex which we had close to 200 crore plus spent there. This year we see that the reverse is likely to happen with the falling raw material prices. We are expecting some release of the working capital. Just to give some number from the balance sheet, last year we had deployed close to 350 crore rupees additional in working capital. So the question remains the same, sir, that with the surplus cash flows which we had this year at the end of FY23, and even if we save some money from the working capital, it is going to be negative this year. So not only just apart from the debt, we should be ending up with the solid cash and reserves at the end of the year. Do we have any plans, given the limited capex plan we have? Do you have any plan to reward it to shareholders in terms of additional distribution of the through dividend or any buyback?
See, this working capital increase that has happened has essentially basically happened from the borrowings, and this will be distributed in the different jurisdictions in different subsidiaries. So as the raw material price is correct, obviously there is also going to be a release of working capital, which will essentially go on to reduce the borrowings.
Okay, so you are saying that we still won't be having a surplus cash on the balance sheet to distribute to the shareholders.
Yeah, correct. You're right.
Okay. Sir, second question is on our realization. So definitely, even the current quarter also, we have seen that on quarter-on-quarter basis also, the realizations of performance and specialty has gone up by close to 14 to 15% on Q-on-Q basis itself, with the performance surfactants net realization from 1,72,000 to close to 2 lakh rupees, and specialty from 2 lakh to 2 lakh 30,000. That is 15% increase. However, the raw material prices have fallen on quarter-on-quarter basis by close to 20%. So I understand that is because of the lag. So we see that from the Q2 itself, this will correct, and the realizations has already started coming down, and our net realization will be down by close to 15 to 20% from Q2 itself, or it will take some time to get it reflected in the revenues.
So what is important, Rohit, is that we need to ensure that we are able to calibrate appropriately in terms of how the market responds to the lower commodity prices, because it's important that we respond well, and that's what we will do. How it pans out in terms of the margins is something is a consequence, but we will do everything that is required to be done in a very calibrated way, ensuring that we protect value as well as our market. So that's the approach we will take. Subsequently, how it pans out will be a consequence, but we do see that things would start, because always, we need to correct the prices in terms of the way the feedstock prices are correcting, because otherwise your demand can get impacted. So we will do what is appropriate.
Okay. And so just last from my side, and this is on basically our new product launches, like that Gelsoft and even the Hearth mix that we have in terms of pots which we have launched this year. How is the performance of Gelsoft and Gelgard and this Hearth mix is coming? And do you see that any major breakthrough in any new product basket which we have for FY23, which can be significant driver for us?
So as I said, it's progressed well in terms of certain projects in pipeline maturing with the customers. But there are good amount of projects in pipeline that are at advanced stage in terms of commercializing. But we need to keep our fingers crossed with the current situation as we explained in terms of recession and the inflation. We need to see as to how quickly this project is rolled out. So we need to wait. But yes, in terms of our engagement with customers and the way that we are progressing, it's in a pretty good state.
That's it, sir, from my side. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Yeah, thank you. Thank you, ladies and gentlemen. We would once again meet about 3 months from now. Thank you once again.
Thank you.
Thank you. On behalf of Galaxy Surfactants Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.